When you hear the word debt, what comes to mind? For most of us, it's a source of stress. Credit card bills, car payments, student loans, it feels like a heavy chain holding us back. But what if I told you that for the world's wealthiest people, debt isn't a chain at all? It's a weapon, a powerful tool they use to build empires, multiply their fortunes, and even pay less in taxes. Today, we're going to pull back the curtain on this high finance secret and explore how billionaires transform debt from a burden into a strategic advantage. This isn't just about borrowing money. It's about a completely different financial mindset that separates the super rich from everyone else. Let's start with the core idea. For an average person, debt is expensive. High interest rates on credit cards or personal loans can feel crippling. But for billionaires, debt is cheap. Lenders see them as incredibly low risk, so they get access to money at rock-bottom interest rates. While we borrow for consumption, like buying a new phone, they borrow for investment. They use this cheap money to buy assets that are expected to generate returns far higher than the interest they have to pay back. This is the concept of leverage, using a little of your own money and a lot of borrowed money to control a huge asset. If the investment pays off, the gains are massive. If it goes wrong, well, the losses are too, but they've built systems to manage that risk. So, why is it so easy for them to borrow cheaply? First, their creditworthiness is off the charts. A massive net worth and a portfolio of stable assets make them a lender's dream. Second, they don't just walk into a local bank. They tap directly into the capital markets, issuing bonds and borrowing from huge institutional investors who are eager to lend them money at low rates. And when central banks lower interest rates to stimulate the economy, it's like a massive sale for the ultra-wealthy, allowing them to refinance and borrow even more at a discount. Let's look at a master of this strategy, Warren Buffett. You might know him as a brilliant investor, but his company, Berkshire Hathaway, is also a masterclass in using other people's money. A huge part of Berkshire's business is insurance, through companies like Geico. Think about how insurance works. You pay your premium today, but the insurance company might not have to pay out a claim for years, if ever. That pool of money collected from premiums, known as float, is essentially an interest-free loan. Berkshire gets to invest this float in stocks, bonds, and entire businesses, generating returns for itself. It's like being given billions of dollars to play with, and you only have to pay it back when claims come due. This is a form of borrowed capital that has fueled Berkshire Hathaway's incredible growth for decades. Real estate is another classic playground for leveraging debt. Take Donald Bren, America's wealthiest real estate developer. His strategy is a textbook example of using debt as a weapon. He borrows money to acquire vast tracts of land. Then he develops that land into valuable commercial and residential properties. The rent and sales from these properties not only cover the loan payments, but also generate massive profits. But here's the genius move. As the property value increases, he can refinance, borrowing even more money against that new, higher value. He then uses that cash to go out and buy his next project. It's a self-perpetuating cycle of wealth creation, all powered by carefully structured debt. Now let's talk about the corporate world, where debt becomes a financial superweapon. One of the most famous strategies is the leveraged buyout, or LBO. This is where a private equity firm, often led by a billionaire investor, buys a whole company using mostly borrowed money. The assets of the company they just bought are used as collateral for the loan. The goal is to improve the company's operations, make it more profitable, and then sell it for a huge gain. The cash flow from the company itself is used to pay down the debt. When it works, the returns can be astronomical, often over 20%, all achieved with a relatively small initial investment of their own capital. Companies also use debt for aggressive expansion. Look at Amazon under Jeff Bezos. For years, Amazon operated on razor-thin profits. Instead of slowly growing using its own earnings, it borrowed billions. That borrowed cash funded the warehouses, technology, and logistics network that now dominate global e-commerce. Borrowing allowed Amazon to scale at a speed that would have been impossible otherwise. This is a common theme. Billionaires like Elon Musk have used debt to build Tesla-esque factories and fund SpaceX's ambitious projects. They're willing to take on debt because they are confident that their vision will eventually generate more than enough revenue to pay it back, and then some. And here's one of the biggest perks of all, the tax advantage. For businesses, the interest paid on debt is usually tax-deductible. This is a game changer. If a company borrows $1 billion and pays $50 million in interest, that $50 million can often be subtracted from its taxable income. In effect, the government is subsidizing their borrowing. This creates a powerful incentive to use debt instead of equity. It's a stark contrast to consumer debt, where the interest you pay on your credit card offers you no tax benefits whatsoever. Corporations even borrow money to buy back their own stock. This might sound strange, but there's a clear logic. When a company buys its own shares, there are fewer shares available on the market. This automatically increases the earnings per share, which often pushes the stock price higher. The wealthy shareholders, including the executives and founders, see their net worth climb. So, instead of using cash to pay down debt, they take on new, cheap debt to directly boost shareholder value. It's a financial maneuver that directly benefits the owners, funded by borrowed money. Of course, all of this involves risk. So how do billionaires get away with it? First, diversification. A loss in one leveraged investment can be offset by gains in 10 others. They're not putting all their eggs in one basket. Second, they have access to an army of experts, the best lawyers, accountants, and financial advisors who structure these deals to minimize risk and maximize returns. And finally, they have deep pockets. A market downturn might sting, but it won't bankrupt them. They have the ability to wait out the storm, refinance their loans, and live to fight another day. So, what can the average person learn from this? While we can't issue corporate bonds, the core principles can be applied safely. The key is to distinguish between good debt and bad debt. Bad debt is borrowing for consumption, things that lose value and don't generate income. Good debt is borrowing for investment, things that have the potential to increase your future earnings, like a sensible student loan for a high-demand career or a carefully planned mortgage on a home in a growing area. The golden rule is simple. Only borrow if the expected return is higher than the cost of the interest. The big picture is that debt is a fundamental part of our financial system. It fuels innovation, builds infrastructure, and allocates capital to where it can be most productive. But the rules of the game are different at the top. Billionaires have mastered the art of using debt not as a liability, but as a lever to multiply their wealth. By borrowing cheaply, investing strategically, and using the tax system to their advantage, they turn what for most is a source of anxiety into their most powerful financial weapon. Understanding this doesn't just give you a glimpse into how the super rich operate. It reveals the hidden mechanics of modern wealth creation. Thanks for watching. If you found this breakdown of financial strategy fascinating, be sure to hit that subscribe button and ring the bell so you don't miss our next video. See you next time.